I think I'll get us going. Welcome, everybody. My name is David MacNicol, and I really appreciate you all taking time out of your busy lives and this incredibly busy city to make it here. And hopefully, we've got some great information for you, and I'll get right into it. So we're very pleased to have David Rosenberg to join us, and he'll be speaking shortly, and Alex Dancy, and I'll do a brief introduction on them when it's their time to speak. The lawyers make us have a disclaimer. We're not giving any sort of investment advice here. You can only do that one-on-one. So to a group, please read our disclaimer. Here's our agenda for today's discussion, and we hopefully will be done in an hour and then have time to have a reception afterwards and mingle and ask more questions one-on-one if you like. So I'll be talking about why risk management is part of our portfolio design. I'll give a very brief overview of the market backdrop. I'll introduce the Safe Harbor Fund, and then we'll do some Q&A at the end. But David Rosenberg will be really focusing on the market backdrop, and Alex Dancy on the Safe Harbor Fund for downside protection. For those of you who don't know who we are and just walked in off the street to join us, but this is a firm that I started in 2001. This September will mark 25 years. I can't believe how quickly 25 years has gone by, but we're very pleased with where we are. We're still 100% independent, so we've stayed away from the banks and the private equity firms and all the other ones who come calling. And because of our independence, it's allowed us to do these things that I know I wouldn't be allowed to do if I was with more of an institution, if you will. We believe that by investing the same way as our clients, that we're totally aligned with them. And those are the type of families we take care of. Private families, everything related to them, trusts, estates, their corporations, and even their charitable foundations. Oh, and special plug, we do have a specialty in pension plans. JP Laporte in the back corner, if you just wave, is a pension lawyer that works with us and specializes in these top hat pension plans. So we're portfolio managers by license by the Ontario Securities Commission, but we really like to talk more about risk management than portfolio management. Risk management is really the most important thing of what we do. We used to be able to rely on a 60-40 portfolio, meaning 60% in stocks and 40% in bonds. But we stopped doing that in 2009, as I'll show you on the next slide why. So we like to diversify across many asset classes, including alternatives. We're not going to talk too much today on alternative assets, but we've got over a 16-year track record, audited track record in that. In my opinion, we were one of the first to start doing this in Canada. Alex Dancy will talk about how we insure our clients' portfolios with portfolio insurance. So I'll leave it to him. And by doing so, it allows us to stay fully invested through this crazy market that we're finding ourselves in on the way to whenever the top is put in. Now, I talk to this chart quite often to existing clients and soon-to-be clients. And the reality is we haven't had a serious setback in the market since 2009. If you look down at the very bottom of that chart, you'll see that in 2009, the S&P 500 bottomed out at 666. Won't forget that number. And now it's approaching 7,000. So it's gone up almost 7 times since that bottom. And there really hasn't been any meaningful setback. You've got COVID there. There's a little blip there, but that recovered quick, as we all know, 2022. And that also recovered very quickly. We expect, we just don't know when, there to be some kind of a setback, unless the market is going to be completely massaged and controlled forever, which I don't see how it can be. Maybe David could talk to that later. So if there is ever a sharp setback of 20% or more, that's where our portfolio insurance will kick in. So that's sort of the magic number you should keep in your mind. It's 20% downside, And for those of you who aren't clients, ask yourself or your advisor, what are you doing to protect against that? And I hope it's not having a strong sell button. I'm going to pass it over to David Rosenberg now to talk about just the market backdrop. He's got some very interesting slides, and he's all warmed up from speaking in Etobicoke, I think, earlier today. I've known David for years, and he's just a great guy and also a great economist, and really knows his way around explaining the markets and the economy and what's going on. So over to you.
Thank you, David, for inviting me, and thanks all of you for coming to this event and to have the economist kick off. That's really something. I don't know whether I should be thanking you or feeling sorry for you, but there's I don't know if you folks know that economists are great hunters. Did you know that? No, we love to hunt. And there's a story about the three economists that go into northern Ontario hunting for deer. And first economist takes the shotgun, pow, and misses 10 yards to the left. Next economist takes a shotgun, aims, pow, misses 10 yards to the right. And the third economist says, nice going, fellas, you nailed them. So I want to say that I've known David MacNicol for many, many years. And I would say that from a investment philosophy and style point of view, we are joined at the hip, because anybody that knows me knows that I'm full square in favor of preservation of capital and the preservation of cash flows at all times. So the presentation today, a little bit of music. I'm looking at a certain vintage in the crowd that certainly, well, correct me if I'm wrong, you would know who Don Ho was, right? 1967, Tiny Bubbles. Well, this is called Not So Tiny Bubbles. And, I'm talking to my good friend and mentor, Tony Fell, who said to me, Dave, can you figure any of this all out? And I said, well, Tony, if you can't, nobody can. And I'm just going to say at the outset, I don't chase bubbles. I don't chase manias. I avoid them. But then again, I basically consider myself to be patient. And I think everybody in the room should probably read Andrew Sorkin Ross's 1929 book. I just bought it. Highly recommend that everybody reads it. And to check your greed in a lockbox right now. So I want to talk about the fact that I was actually hoping. Now, I don't like war. I'm anti-war. But I was thinking, boy, if this war creates a panic. And I wrote a whole report that you should never really invest around geopolitics. Domestic politics, that's different. And I was hoping there was going to be an excessive negative reaction. The S&P 500 is down like what? 8.5%? The VIX at 30? It got to 60 in Liberation Day last year. So I was actually hoping for a great buying opportunity, but it never came. So I'll just move on until the real, true panic buying opportunity comes. Because the one thing I know about history is that there are no new eras, and that everything moves in cycles. Everything moves in cycles. Life moves in cycles. Nature and the balance. Everything moves in balance. The markets move in cycles. There's no such thing as a permanent bull market, and there's no such thing as a permanent bear market. But I'm going to get in when people say to me, Rosenberg, what keeps you up at night? I'll get into that. But let's go back to October. October pre-war. What does Jamie Dimon say on October 14th? He says that he is seeing bubbles. This is a guy that leads the biggest bank in the United States. Outside of Tony, who's smarter than Jamie Dimon? And he's talking about bubbles. And here, the market is up 12% since that time. We all know what it's done since the end of March. But since the time, so it just goes to show that bubbles doesn't mean you're on a market peak about to crash. Bubbles means you are in extra innings. You're past the 9th inning. And historically, by the way, before they brought in this rule about starting at second base, extra innings used to go to the 14th inning. Okay? But we're past the 9th inning. When people ask me, where are we in this game? We're past the 9th inning. And let's go through what the different elements, the Kubler-Ross stages of bubbles. Okay, so let's go into leverage. Leverage. You know who taught me about leverage, defining a bubble? Was my friend Richard Bernstein when he was chief strategist at Merrill in New York and I was chief economist. Look at this chart. Look at the leverage underpinning the market right now. FINRA margin debt first crossed $1 trillion last summer. It's gone up more than 20% since. Not just that, but in the past year, the leverage underpinning the market is up 40%. The market itself is up 20%. So the leverage is running at double the appreciation in the stock market. And then you're taking a look at positioning. How are hedge funds positioned? Right at the top end of the range. Everybody is all in. What about not just hedge funds, but your classic portfolio manager at mutual fund X, Y, or Z? They've run their cash holdings down to 1%. It's never been this low. Everybody now is all in at the same time because if you underperform in this market, in a bull market rally, you will get pasted and your clients will leave you. So that's the big fear amongst portfolio managers. And then you go to sentiment. Go to sentiment. Because, we're talking about the stock market here. What goes into the stock market? Valuations. I'll get into that. And market positioning. And technicals. And fund flows. But sentiment. Sentiment. When John Maynard Keynes coined the phrase animal spirits in the 1930s, he wasn't talking about GDP. He wasn't talking about the economy. The economy is not the market. He was talking about the stock market, animal spirits, the sentiment that drives the price earnings multiple. And the sentiment is driven by extremes, the extreme emotions of fear and greed. Nobody remembers the fear. I do, because I was on the front lines of Merrill Lynch back in March of 2009. I was there at Merrill Lynch Canada back in early 2002. I've been doing this for 40 years. When people lose their grip on reality and they lose their sense of what are the extremes, and here you're talking about the ebullience and enthusiasm and excitement after this huge bull market we've had since really the COVID lows back in early 2020. So sentiment is right pressing up against the top end of the range. And I will tell you right now, I am a contrarian to the heart. I do not follow the herd. Okay. And right now, everything is just a little too one-sided. Now, Bob Farrell, show of hands, who knows what Bob Farrell is? Going once, going twice. That's it. Go place 2 tables of bridge at the end of the game, at the end of the presentation. So Bob Farrell was the Merrill Lynch's chief market strategist for like 50 years. I highly advise everybody Google this man. He's a living legend. He's still alive, actually. And rule number 7 is all about market concentration. What happens, how unhealthy a market is when it gets this concentrated. So here we are, and we have technology once again. That's always where the innovation takes place. And here we have the technology share of the stock market now higher than it was at the bubble peak back in the late 1990s. We take a look here at the fact that we have the top 10 companies. Today's Nifty 50. Once again, 40% of the market cap dominated by 10 companies. And here they are. And what's interesting is that, we all talk about the dot-com bubble, but only 5 tech companies were in the top 10 back in March 2000. 8 of them are today. And take a look at some of these numbers. Take a look at the size of the market cap. Microsoft was the biggest company a fraction of what NVIDIA is now. Take a look at these mega caps. And they are the ones that are driving the market. The generals are driving the market to the point where the top 10 US stocks in the United States are now bigger than the GDPs of other countries in the world. Question is, does it make sense? So we have the concentration, we have the sentiment, we have the market positioning. Everything is at an extreme. And now it's become more extreme because of the war. But then if you remember, the market started going gangbusters before Pfizer Monday in 2020. Sometimes the animal spirits, you can't even understand what's causing them. And then when it goes the other way, you're looking for explanations. And you have every Tom, Dick, and Harry, analyst, strategist, economist on CNBC or Fox Business or Bloomberg, always fitting the narrative to the price movement. Now, these are the valuations. Pick your poison. I could have put more on there. You have price to earnings. You have price to book. You have price to sales. Sales you can't fudge. Sales are sales. These are all 2 to 3 standard deviation events. I mean, do you really want to buy the market now? And yes, I understand what the market has done. The fact that we've gone from bubble to super bubble doesn't impress me too much. Here's the Buffett indicator, the market cap to GDP ratio. These numbers, do they make sense to anybody in this room? And then the one metric I like to look at the most is the Bob Shiller PE ratio, the CAPE, cyclically adjusted price earnings multiple, which smooths the cycle over 10-year periods. It goes back a century. This is the 3rd biggest bubble on record. And I'm supposed to be advising people that they want to chase this thing. I agree with Dave MacNicol. This is going to end badly. What the catalyst is or the timing, to me, is frankly, I'll tell you the truth, I don't really care. You just have to know that it's out there. And I have my concerns about that. Not just that, but, they say that valuations, well, you hear this all the time, right? Valuations are not a timing tool. Do you not hear that? No? Yes? No? Who cares? Nobody ever said you look at multiples for timing. You might look at technicals for timing. The valuations are important because they tell you at any point, are you investing with the wind at your back or the wind in your face? And when we have this CAPE multiple, which is now close to 40, when it's over 35, those are your future returns historically. 1 year, 3 year, 5 year, 10 year. When the multiple's this high, I want to wait for the multiple. Now, I don't want another war to break out, but I want to see a semblance of sanity. I want to see rational thought come back into the stock market. And frankly, I don't give a damn how long that's going to take. Why would I relegate anybody to a future of negative returns? Because you're buying the market today, you are subjecting yourself to a future of negative returns. Unless you want to say, well, it's different this time. But that's not my philosophy. And as I'm talking about this, there's no market in the world that's really, truly, quote, cheap. But the only market I'm talking about is the one that's fixated. Everybody's fixated on the beloved S&P 500 is really the only one that stands out as having been this expensive barely more than 1% of the time in the past. There's other markets in the world, by the way, that you can invest in that aren't nearly as expensive. But here's what really keeps me up at night, okay? These sets of charts. This is the over ownership. This is household ownership of equities. Do you see that chart? $60 trillion? You're going to say, well, but what share of that is on the household balance sheet? Well, 72%, never been this high. Household, the general public's exposure to equities has never been as high as it is today. 72%. Higher than it was in the late 90s, higher than it was in 2007. And this is what it looks like right now. You have 72% in stocks. You have 7% in bonds, 20% in cash. 7% in bonds. People say to me, what do you like bonds for? Because I'm telling you, I'm a contrarian. You go to the cocktail party and talk about bonds, people are going to look at you like you got leprosy. I mean, they're gonna. You want to make friends, don't you? Why would you talk about bonds? No, nobody owns them. Well, therefore, I'm a contrarian. I don't follow the herd. Okay. So when we're taking a look at what's going on here, that's so unusual, is we got these consumer confidence numbers which reflect people's perception of the economy. It's at a record low. The chart on the left, that's the perception of the economy, and the chart on the right is consumer sentiment on the stock market. So the economy sucks. Value or Intel. Okay, so basically, does that chart, no, I'm going to ask a question. Does that chart make sense to you? You understand this whole presentation is about these massive imbalances and divergences and extremes that really have me unnerved. And then we get to the economy, and they talk about the K-shaped economy, and the Ks are everywhere. Look at AI CapEx. AI CapEx is booming. That's all you read in the newspapers. AI CapEx, $725 billion by 4 companies. What about that bar chart on the right about XAI CapEx, the old, what we used to call the old economy? The AI is sapping the resources out of the old economy. There's no capital spending boom in the United States. There's an AI spending boom. The other half of capital spending is going down. Then you got employment. The only source of employment going up in the United States is health and education because it never goes down for obvious reasons. The other 82% of people say, oh my God, we got the Friday numbers on non-farm payrolls, and to listen to the, really to the, I don't even know what to call them. I was going to say pimps, but I don't want to be rude. But the other 82% of the labor market is contracting. And you got people thinking this is a good labor market. That's all I heard on CNBC today. And then you look at consumer confidence at the high end is flat year over year. Look at the low end. And then take a look at what's happening here. Corporate profits are surging. You hear the CNBC, corporate profits. They had Ed Yardeni on today, corporate profits. It's 20% of national income. What about personal income? What about personal income? Look at the gap. All these Ks are divergences. There's almost no growth in real personal income that drives the economy. And then it goes to show that the profit share of the economy has just continued to go up and up to record highs. Labor share of the economy. Now, I'm not socialist, okay? I'm a capitalist with a heart. They would have called me a red Tory back in the day. But this is problematic. Nobody talks about it. Okay? And here's what the economy looks like. This is where employment growth is right now, year over year, 0.2%. I show you where employment growth is at the start of every single recession in the post-war era. We're down to 0.2. Normally, you're like 1 to 2%. You know, when I started in the business at the Bank of Nova Scotia back in 1987, okay, I was a desk economist. When we got employment growth down to like 1%, people would say to me, Rosie, when's the recession starting? We're at 0.2. And nobody thinks they're going to have a recession because the market cycle's been repealed and the economic cycle's been repealed. And like, my eyes are bugging out of my head. Maybe I'm just too old. I don't know. Look at this chart. This says a lot right now. Look at labor input. Labor input on the left-hand side. That is basically bodies and hours worked. Almost at zero. And look at productivity on the right. We're starting to see the AI, the wonders of AI. Let me tell you about AI, okay? Claude. AI's not making us produce more. We're not producing more. We're just producing faster. We're producing faster. That's what we're doing at the expense of labor, and it's early days yet. But I'm looking at these numbers, and did you know in the past 2 years, 90% of the growth in the economy has come from productivity? 90. Now you're going to ask me, well, what's the big deal about that? Well, because in a normally functioning, well-balanced economy, it's usually 50-50. Productivity and labor output are equal. And even when you look at the historical major innovations, the microprocessing chip, the mainframe, the personal computer, the internet, it's usually at the peak of that innovation cycle 70-30. It's now 90-10. 90% of the economy is productivity. There's no labor input. Nobody talks about this stuff. But what's this going to mean for employment in the future? What's it going to mean for wages? Take a look at this chart. This is actually what people are telling you. I don't know where the Fed You see, the Fed talks about all the data get revised. The government data get revised. It's always done on a small sample size. This is University of Michigan consumer sentiment. It goes back to 1952. And this is people's perception of higher unemployment. It's never been this high without going into recession. Nobody talks about that. The job finding rate, the ability to find a job if you're unemployed, is down to a record low. What am I missing? Yeah, the stock market's going to new highs. Massive divergence between the economy and the stock market, no doubt. And this is what AI is doing to the job market. These are pink slip announcements over the past 10 months. That thing is going up a lot. And it's the reason why there is tremendous job anxiety. They have basically 1/5 of the working class now fear losing their job in the next 5 years. So AI is the internet on steroids. We have not seen labor saving technology like this ever. And I think a lot of people are complacent about it. What about the probability of having an income increase in the next year? Barely more than 40% of the people out there think they're going to get a pay hike. What? And I'm supposed to have inflation on the grain? Tony, tell whoever it is to buy bonds right now. And this is the median wage gain. This is the median wage gain. It's like 0.5%. Somebody explain to me how we are going to squeeze the oil, gas, food inflation in a general inflation. Well, nobody's making any money. It's going to cause deflation of the rest of the economy. The other 80% of the economy is going to get crushed because of this oil and food shock the longer the Strait of Hormuz is closed. The Indeed wage tracker is back to where it was pre-COVID. Like, what am I missing? What do people not understand? I hear about inflation on their brain. Inflation. Because of oil? Really? No, that's not sustainable. It'll give you a few months of inflation. Here's Kevin Morris is about to go from the Fed. His favorite inflation number, the trimming, and it excludes, the Bank of Canada looks at this too, by the way. It just removes the volatility on both tails of the price numbers. So these numbers are heading down towards target. This was happening before the war. I'm looking at these numbers, very interesting. Very interesting, don't you think? Because weren't tariffs supposed to create all this inflation? Wasn't the Bank of Canada all concerned about inflation because of the tariffs? Canadian inflation is like below the Bank of Canada's target. And you have the bond traders thinking they're going to raise interest rates, which I think is absolutely insane. Speaking of Kevin Morris, let's just say this. He's about to take over from the Fed. I'm going to say this right now. Whenever, all the way back to Eccles in the 30s, and this is just Mother Nature, whenever you have a new central bank chairman or chairwoman, since Jenny Yellen was in there, they face a crisis within the first 1 to 2 years. They face a crisis. So here you have, where's the VIX? Where'd the VIX close today, Tony? Like 17? That's about where we are. It's a teenager. Yeah. I tell you, buying volatility, not a bad idea. So we got other things going on here. What about the politics? Well, we got a midterm election coming up in November, and it looks like Donald Trump's Republican Party is in trouble, and that's why he's trying to back out of this war. The polls look terrible for the Republicans, even with the gerrymandering. And so we're going to have the midterms. I think that, we always knew the House was going to go Democrat. Now the Senate's in play, really. But take a look what happens when you have a change, no matter who's in power. After the election, when there's one power rule and you get fiscal gridlock, it's great for bonds. This is great for interest rates, by the way. It means inflation goes down. You know why? Because we're not going to get any more fiscal stimulus. The one big, beautiful bill was the last kick at the can for a long time period. The age of fiscal stimulus. Do you see this chart here? You think the U.S. economy is running on fumes? Fiscal fumes. 6 years in a row of 5% plus deficit GDP ratios. We've been running deficit GDP ratios in the United States. And people complain about what's happening in Ottawa. You kidding me? 2% deficit GDP ratio? 5%. And people talk, and I hear the U.S. is the global growth engine. No one has blown out the fiscal side more than President Trump has. And he's a Republican. Look at these fiscal deficits. The bar's going down, and look at the debt ratio. So I have a sense that the Democrats, and then in 2028, probably will be a clean sweep for the Democrats. This is how see, the political cycles move in cycles too. We're going to go through a period of fiscal drag. We're going to go through a period of Bob Farrell's rule number 1 on mean reversion. And I got news for you. It's already starting. You paying attention to what's happening in the States, at the state level in the States, in the blue states where governors are raising taxes and they're raising wealth taxes. So a lot of these Ks I'm talking about before, those are going to mean revert too. And it's going to be the revenge of labor over the capitalists. Now, it won't be inflationary because we're still going to have the AI productivity. That's not going away. But taxes in the United States, this is my call. They're going up. And it's not going to be good news for the stock market and not remotely priced in. How much time do I have still?
About 5.
I got 5 minutes, 3 timeouts? No? I want it to be 5 minutes. I want to talk about a couple of things I like. I like gold. I like gold because it's a great diversifier balance in the portfolio. I wrote my first gold report in 2010 when I was a Gluskin chef, when it was $1,000 an ounce. And I still like gold. And I like the gold miners. And you can't take a look at the bull market in gold without looking at the context of the bear market, the secular bear market that started in 1980 and ended in 1999. You can't look at one without the other. Gold went from 850 down to 255 in a 20-year period. Nobody wanted to touch it. Why? The central banks were selling gold over the whole 20-year period, led by the Bank of Canada. And you know, we're the world's 4th largest gold producer in the world. The Bank of Canada has no gold in the vault. My maternal grandmother would have said, how meshuggah is that? But you're taking a look at this chart, it tells you what's going on. Because why did gold bottom in December 1999? What was magical about that month was the Washington Agreement, where the European central banks met and they said we're establishing a moratorium on the sales of gold. And gold bottom. And just not by selling, it went from $255 up to $1,000 an ounce in 2010 when I wrote my first gold report when I was a Gluskin chef. What happened in 2010 that was special was that the first year that the central banks were net buyers of gold at an annual basis and have been ever since. So ignore central banks at your peril, okay? They're always at the poker table with the rest of us. So what's happened is that they have been reestablishing, call it de-dollarization. They are increasing the share of the foreign exchange reserves into bullion. And this chart will mean revert. And mean revert means that you go through the mean. Mean revert does not mean you stop at the mean. It means correcting two extremes. This chart is telling me right now that we're going to blow through $6,000 an ounce and probably a lot higher. So pay attention to what the central banks are doing. The first time I hear either a central bank saying I'm not buying any more gold, or the day that I changed my name from Rosenberg to Goldberg, you know the trade is over. But so far that hasn't happened. I also like interest rates. I like it. No, everybody hates them. I don't care. The nominal yield on the long bond is about 5%. The real yield, you know, you can buy the real yield on the S&P 500 is 2.5%. Did you know that? That's the inverse of the Kate multiple. The real yield on the long bond is 2.7%. Do you ever stop to think about that math? 2.5% real yield in the stock market, 2.7% real yield in the bond market. What's that telling me? That the equity risk premium is negative. Does that make sense to people in the room? When the ERP is zero, below zero, do you understand what the market's trying to tell you? The market's telling you that equities have emerged as a riskless asset class. There's no risk in equities. But we all know, because we all learned from Harry Markowitz, that you do need to have a premium. You do need to have, you need to be paid to take on equity risk. But right now, if you're buying the market, you're paying to take on the equity risk. That's how this has turned into a market of what I say irrational thought. Look at the net speculative short position of the long bond. Look at the real yield. When the real yield is 2.7%, you want to talk about not losing money, you won't lose money in the bond market. You have such a big cushion. The antithesis of what happened if you were buying the bond market in 2021, 2022, you have a big real interest rate cushion. And they carry very low. When you look at where long bonds trade relative to the short end, relative to the mid part of the curve, very, very attractive. You're picking up a very nice spread. And I think that in 12 months' time, we will be talking about disinflation or deflation, not inflation. Let me just remind you, when oil was testing $150 for the first time, well, my friend Jeff Rubin was writing books on oil going to $200. Do you remember back in the summer of 2008? Surely people here remember that. Inflation was going to 6%. Never mind. Oh, we can't get to the 2% target. Inflation was going to 6% in the summer of 08. The ECB, those idiots, raised interest rates. The Fed shifted to a tightening stance. Bernanke was on the precipice of raising interest rates in July of 2008, 2 months before Lehman collapsed. Inflation was 6%. Oil was 150. Where was inflation a year later? Where was it? -2. So when I say that, we'll be talking about deflation a year from now. People say, Rosenberg, you're a little nutbar. I'll say, yeah, but I've got news for you. History is on my side. And as Forrest Gump said at the reflection pool, that's all I have to say about that. So thanks very much, everybody.
Okay. Thanks, Dave. That was great. We're going to be really cheesy. I've got a little draw for these 6 books, but they're more related to Alex's presentation. So I think I'll do it after Alex is done and maybe after the Q&A. So Alex, over to you.
Well, thank you for that presentation. That was fantastic. I really enjoyed that. Me is here. Okay. All right, so I'm going to be talking about the Safe Harbor Fund. My name is Alex Dancy with Lionscrest. I've been involved with our sub-advisor, Universe Investments, now since 2017, and the gentleman that I work for actually started working with Nassim Taleb and Mark Spitznagel, who run Universa as early as 2000 when they were known as Empirica Capital. So he's been with them since the beginning now for 26 years. And there's a lot of fascinating things that happen with the hedging tool that we've used. And one of the things that Dave and I talked about maybe 4.5 years ago was, how can we work with Canadian clients? And the rules and regulations in Canada are very different from other areas that we work in. So that's when Dave said, well, you know what, we're going to create the Safe Harbor Fund. So he's got a great entry into the protection where he works with his clients, and it's been a great partnership. So we really enjoyed working with Dave and all of his other associates. So thank you for that, Dave. So the way it works is we take a very small amount of capital, generally between 1% and 3% of capital, and that's our funding mechanism. We're simply buying options, and with those options, we call that the Universal Black Swan Protection Protocol. So it's a highly convex risk mitigation strategy. What do I mean by that? So to what Dave was saying earlier about the VIX, the volatility index on Liberation Day back in April of 25, when he announced the tariffs, the VIX spiked up to 60, and we were kissing the Black Swan territory. And so instantly that morning, about an hour later, I get an email from Universal saying, hey, we just captured around 60 basis points. And then later on, we found out that it was closer to 90 basis points on our protected capital. So those are the things they do. So one of the things that Nassim always says is don't be picking up pennies in front of the steamroller. That's not what we're doing. We're not here to protect against small losses in the market. It's catastrophic events. And those catastrophic events can wipe out wealth, the terminal wealth that you're building. And so what we do is we target a 20% return of your capital on a 20% loss. That's the idea. So those types of options that they're purchasing are deep on the money puts. That's the predominant options that they're buying. They're completely confidential. I don't even receive a statement. I just have an NAV that we receive with the profit loss. But that's how they work. Yeah, we've been with them for some time. So why mitigate? Well, a lot of this, I think, was covered in the presentation with Dave Rosenberg, but, and Dave MacNicol and his team have even been at the Universal office to meet with Mark Spitznagel. And one of the questions was, when do you expect the next market crash to happen? And Mark was like, I have no idea. We don't try to project when that will happen, but we know based on history and history is your defense, and that's their defense. Because we know historically it's going to happen. We just didn't know when. And so you want that liquidity. And so when you have that, you have the capability of buying equities at lower market prices immediately after that. So that's what we do. And so it's really hard to compound returns with large losses. This is a great chart. So if you're long the market, your compounded annual growth return in the S&P over the past 20 years has had the best return. If you're trying to time the market and you missed the 5 best days, you would have had a compounded return of 6.29%. And if you missed the 35 best days over the past 25 years, you would have had a negative return of 1.27% compounded. So there's something to say about being long the market. So this is a chart, and there's a great video on YouTube if you type in Mark Spitznagel or Universa Investments. And this slide comes from that video, but the amount of capital you're putting in, that $3 to protect $97. The goal for that capital is for that capital to last about 18 months. Could be longer or shorter. And so now you're long the market. And if you have a drag on your portfolio compared to the S&P 500 or the equities that you hold by 1 or 1.5%, what is the opportunity cost that you're losing if you weren't long the market? If you're going into the terrible word bonds, right? It's huge difference. You look at 2019 through 2025 on those annual returns of the S&P. Every year was double-digit growth except for 2022. And so when you have 5 out of those 6 years where you're getting 10, 15, 20, 1 year was 28% return, and you're dragging that by, say, 1.5%, it can be remarkable. So this allows you to stay long the market. And when that loss does happen, we want to replace that capital. So we get you back to even. That's the goal. Because if you're even and your neighbor's at $80 and you're now back at $100 and you just bought in at lower equity prices, the compounding effect on that could be massive. So this is their Model 6 portfolio in the gold protected. And this is with a 3% allocation of capital to hedge with us. And then you can see that in the blue line, that's their model, which is in the middle. And then you have also a 60-40 portfolio, which is on the bottom line, that gray line. So I know that their model goes back. When did you start that, Dave? I can't remember.
Day 1, 2001.
Yeah, 2001. Okay. Yeah. So, but through our sub-advisor, we can show this going back to the early days with Universa, which started hedging in September of 2008. That's not a cherry-picked month, September 2008. That's the actual month that started. So the timing was absolutely perfect. This is my favorite slide. And you can't read it from the back row, but I'm going to describe it to you. So on the far right of this page, this is showing the number of months over 125 years. Can you all hear me okay? All right. So if you look here from 1901 to 2025, we've had 33 months where the return of the S&P 500 was between 10 to 50%. Now, when I'm talking about the S&P 500, before the mid-1950s, there was a 200 stock portfolio. Before that, there was a 90 stock portfolio that was the market. And then prior to that was a 20 stock portfolio, which was mainly industrials compared to the S&P. But based off the large market of the U.S. S&P, we've had 30 months where the return for the month was between -10 and -30% in a single month. Now, Over 125 years, there's 1,500 months. 30 of those 1,500 months, we've had market crashes. So that's 2% of the time. And if you look at the past 20 years, that's been the same instance, 2% of the time. So just like we had October of 08 and we had March of 2020, we are due based on our friend history. When it will happen, I have no idea. Now, this on the left talks about the annual compounded return of the S&P, or the equivalent of the S&P, of that same time period, 1901 to 2025. It's been 9.6% on the CAGR, or compound annual growth return. What if we got these scissors and clipped the left tail? We removed those 30 months that had the -10 to -30% return. And let's just assume that by having the portfolio insurance in place and replacing that loss, your total return for those 30 months was 0%. No gain, no loss. We just replace the loss. Your compounding annual growth return of that time period now would be 14.1% versus the 9.6%. This to me is powerful. I did an interview late last year at the New York Stock Exchange talking about this chart. If you go to YouTube and just type in Alex Dancy, you can see it. It's about a 9-minute video, but it really goes in deeper to what we're doing here with Dave and his team on Safe Harbor Fund.
I will. So yeah, this is just more housekeeping here. So it shows who the manager is. That's us in Canada, supported by Lionscrest through Alex's firm, and then underlying with Universa with Nassim Taleb and Mark Spitznagel. Those are our auditors. We've been working with Goodman and Associates for the 16 years that our alternative asset program has been running. They're excellent. Fund administrator is SGGG. They're the largest in Canada doing that. And Stegman Elliott is our legal team behind this. It's the overall structure for Canadian investors is a underlying limited partnership, but we were able to put a master trust wrapper on it. And so that allows it to be available to any type of an account. And it used to be we had to only allow accredited investors into this. And then fortunately the regulators came around and they now give us the authority to approve people. So all of our clients have this. Not one out of 550 families, not one has opted out. We've had a number that really question it, and we've taken them through the logic over and over. Thanks to Alex's help, they've done the right thing and allowed us to do this. So the biggest risk is that this market never has a significant setback. And by never, I mean in the next 5 years, let's say it just continues to move on. About every 18 months, this will dissipate down to zero. So there is a cost, an additional cost. It's almost like having a second management fee. But this one we can write off when it's not working, or when it does kick in, like it did during COVID and definitely during 2008. That's what we'll see what happens then. So what we've done here, just to summarize, we've got downside protection for a very low cost. I'll tell a very quick story. When I started interviewing Universa, I first heard about them in March of 2000. I was flipping through a Forbes magazine and looking at all the various funds and what they've done in the U.S., and they're all negative numbers. And there was this one that jumped off the page, said 3,500%. That can't be right. And it wasn't called Universa. It was Nassim's predecessor firm. Found out, started to interview them then, and finally got around to doing it in 2022. In mid-2022, we did our first allocation within our alternative platform. And then the second half of 22 happened, and I thought we were very lucky geniuses. And only to find out that the market only ticked down very slowly over 6 months, 19%. Not enough for the VIX and everything to kick in. So that was a learning lesson then. We don't want the market to crash, just like we don't want our homes to burn down and collect on the fire insurance. But we've got it in place in advance. So the end of my story is, after a couple meetings with Universa, this would be about almost 10 years ago, I still didn't like, and I don't like investing in black boxes. I'm an engineer by training. I like to know what's going on. And so I invited an engineering friend of mine to join in on the meetings. And I'll leave him nameless, but very smart guy. He went through Western Engineering, top of the class in my class, Harvard MBA. He went on to run Citibank's derivatives, and then he went on to run TD's treasury. So he knows his way around derivatives and options. And after 2 more meetings with Universa, he said, okay, leave it with me. I'm going to try to find a way to recreate this, and we can do this together in an open book process. After 6 months, he came back and said, okay, I've got to figure it out, but you're going to have to put up 20% of your client's cap. And I'm like, no, we 20% is just too much. You know, Warren Buffett right now has 35% of Berkshire Hathaway's money in cash right now. Kudos to him. I wish we could do that, but if we did that, I know what would happen. The clients would start following the next week and just taking the money away, putting it somewhere else. So, you know, we're sort of conflicted that way, but we think we're doing the best we can in terms of the circumstances. We've got some expertise guidance helping us along the way. And really for terminal wealth growth, that's what this is really all about, that we can still continue to compound. As they say, you can't compound negative returns. You can compound only positive ones. And I think we're at the Q&A part now. Just to maybe wake everybody up a bit, I'm going to call some names out for these books. There's 2 books here. This one, written, the most recent one by Nassim Taleb. You might have heard of his other books, Fooled by Randomness and The Black Swan. And this one's by Mark Spitznagel, who's his business partner. So let's just do 6 quick names here, and maybe I'll let you deliver. Sure. I'd love for you to choose.
All right, I'll go first back here.
Thanks, Phil.
An internally asked question. Are there any other positive payouts in this fund other than 08 and 2020? More positive returns, I should say.
So we've had years where the returns have been either flat or slightly positive, but as far as the two big events, it was October of 08 and March of 2020 was correct. Go ahead.
Sir, you mentioned that gold you think would rise to 6,000. I've heard 10,000. Why is some people saying 10,000?
I'll tell you why. 10 yards to the left, 10 yards to the right. If we do a full round trip back to, remember that we started at the gold price peak in 1980, 70% of FX reserves were in gold, and then they got down to 10%. Now we're around 30. So if you believe that we're going to go back to the old peak, you'll get to 10,000. So I didn't go all the way there. So I did just a little bit above the mean. And look, we almost got there in January. So that was well ahead of my expectations. And actually, I trimmed some of my positions then in light of that. It was moving too far, too fast. Fall in love with your partner, not your forecast. Your forecast won't love you back more often than not.
There was it by gold or gold shares? Top quality gold share.
Well, I think that you'll get, you saw, the thing is about the gold shares that they're part of the stock market. So you saw what they did when the stock market was going down. But I would say that the optionality would be in the gold mining shares. And we have both.
Yeah.
So we have a mix. I mean, I like the physical gold. I like the gold coins. I like the bullion. The shares are just a piece of paper. But I'd say the gold shares have more upside. Yeah, sure.
Yeah, definitely a lot more leverage with gold mining companies. We've been very fortunate this year. One spec name that we did a year and a half ago. This is totally blowing our own horn, but I don't care. It was just one of those positions where if it went to zero, it would have been about a 1% loss for our clients. And now it's been a 23 bagger. And now we've got a real dilemma as to and it's still due for another double, according to many people, not just management, of course. And so we're in this precarious position where it's outsized within the portfolio. And this is sort of a greatest problem you could ever have. But we're big believers in gold as well. That's one reason why I left my former partnership. I remember in 2001, it was $284 was the entry point. And now, and people rarely talk about the margins of these gold miners, the top producing quality ones. They're well over 50% margins in cash flow. There's not really another industry like that right now, other than maybe some top end technology. Anyway, so we're big believers of it, and like Dave Rosenberg, we don't think that we're done yet.
So a double upside is coming on your preferred choice that you just are talking about right now?
Just don't know the timelines. But
Okay, so you want to share what the name of the company is, please?
I'll tell you after. Yeah, so I don't want to get people buying at the top here, just in case it doesn't work out. I'll talk to you guys about it.
The other day, you're calling for a major downturn at some point, unpredictable. So that market, you're also calling for an economic collapse.
Well, I never said economic collapse. No. Here's the thing: the economy doesn't collapse. I mean, I guess you would say in the Great Depression, the economy collapsed. With the revisions, the economy didn't even collapse in the Great Recession. The stock market collapsed. In the tech wreck, real GDP went down 0.2%. Did you know that? And the stock market was down 60%. Okay, so no, I didn't say the economy was going to crash. Will we get a recession? I showed you some charts that are telling me that, there's a good chance we will. You will say, well, you said there's going to be a recession in 2022. And I'll say, yes, and I was wrong. What I underestimated was that we had $2 trillion of pandemic stimulus checks in people's pocketbooks, $2 trillion. And every penny of it got spent, which I didn't anticipate because of my business called economics, forecasting. Well, your assumptions drive your conclusions. And my assumption was wrong. All that money got spent. So this is actually narcissism on steroids. Do you see $2 trillion in excess savings right now from fiscal stimulus? No. So it's not there. And I would say that this much is that when I looked at the first quarter GDP number in the United States, and I looked at the fourth quarter, I could tell you that over 70% of the U.S. economy right now is in a recession. Even though the economy might not be in a technical recession, over 70%. So it just goes to show you how lopsided things are, because AI is driving the whole thing. AI and the spending at the high end because of people's equity market holdings, people feel richer at the high end and they're spending. Everything else is basically not good at all. Am I calling for a crash? No. But I said before, either you believe in cycles or you don't. I don't believe the world is flat either. Okay. And I don't believe we're in such a new era where there's no more cycles. People said the same BS around the internet. We're in a new era. The internet was going to cause business cycles to be repealed. And we're hearing the same sort of claptrap today, except the problem is that the valuations are more extreme and the concentration is more extreme. And not just the concentration in the stock market, but the concentration of people's portfolios. I said before, like my own age range, I'm a baby boomer. I'm 65. The baby boomers, their allocation equities in their financial asset mix is 60%. 60. It should be 40. It's 60. Everybody is all in at the same time. So I would say this much. I'm not calling for a crash. But could there be a crash? I said before, I'm really concerned what happens at the peak. And everybody thinks they can time the exit and everybody's all in at the same time. And we're going to have a flow of fund crisis with everybody is trying to get out at the same time and nobody has any liquidity. So I'm not calling for a crash. I don't want to scare anybody. But this is the sort of stuff that keeps me up at night. And then what happens to the people my age and older that get hurt really bad, that retired with this golden goose nest egg? What are they going to do, Tony, when they see that they're down 40 or 50%? Because the median age of the boomer during the dot-com crisis, the tech wreck, was like 45. What's the median age today? Like 70. Time is not on your side, and everybody's all at the same time, and everybody's just walking around, can't see past the tip of their nose. So this psychology really has me perturbed.
Didn't your chart show what percentage of household wealth is in
Household financial assets, 72%.
72%? Well, if you have, let's say, a 1/3 drop, that's going to put have a huge economic impact on the housing market.
Well, let me just tell you, and the person who will make the most money is going to be Sorkin, because his 1929 books will be flying off the shelf. Mind you, probably at half price.
Yeah, but just before that, 1 second, Dan, just another pointer. And there's a lot of valuable information in here. It's not just marketing for our business. And thank you, Luke, for pulling it together. But there's a great old math equation here. If you're down 20% in your portfolio, you've got to get a 25% return to get back to break even. If you're down 30, you need 43%. You're down 40%, you need 67% return to get back to break even. Finally, if you're down 50%, and let's hope that doesn't happen, you need to double your portfolio just to get back to break even. So
Help their work on math.
yeah, it's just and no one understands it until they're deep in it, and that's why I hope it doesn't pay off. I hope we have this graduated return forever, but it just won't. You'll look back, it'll be something in hindsight 6 months back, and you'll go, that's what the trigger was. Here we are now. Dan, you got a question?
It kind of just answered it, but what do you make of the argument too big to fail? Like the top 8 that are really pushing it are these companies that have so much resources, so much cash behind them. Like, and I know cyclicals, it's screaming for the bubble to burst. But the difference is now these companies are just so huge. Like you had mentioned, if you put them all together, they're larger than some GDPs of most countries. So it's like, I keep hearing the argument, there could be a crash, but these government or these companies are almost like governments now where they could bail themselves out.
How do they bail themselves out?
But they have so much liquidity. They have so much.
Are you looking at the cash burn? What's happening in AI right now? These companies have burned through cash so much, they're actually issuing bonds that are the size of treasury auctions. This has all changed. Everything's changed. They're not financing this capex off their cash anymore, and nobody's talking about companies going bankrupt. Look at what Intel's doing right now, after being in purgatory for like 20 years.
Yeah.
Now everybody can't get enough Intel. Okay, give me a break. Intel's not bankrupt. Now, okay, Donald Trump puts a stake into Intel and some other things. But I mean, Intel went down like 80%. Didn't go bankrupt. Microsoft went down like 70%. It didn't go bankrupt. Cisco went down like 60%. It didn't go bankrupt. A lot of those companies that were in the top 10 I showed you for March 2000, they didn't go bankrupt. They just had their stock price have the shit kicked out of it. That's all. They didn't go bankrupt. It's just that those are not the stocks you want to own at the peak. And I'm not calling the peak. However, I said we're in extra innings. We are in extra innings by every valuation metric. So, why take the chance? Go to Vegas. Have some fun. They'll give you drinks for free. I've been there in a while.
That's good.
Yes, sir. Yeah. Can you explain about the same part of the 3% or like it's what there's a downturn and how it will be benefit to clients?
Yeah, sure. So I can't go into the 97% of the portfolio, but Dave and his team can talk about that. But I can talk about the insurance. So there's going to be predominantly deep out of the money puts against the S&P 500 that range in duration from 1 to 9 months. That's the bulk of the options that are being purchased by our sub-advisor, Universe Investments. They have a huge appetite So the market makers are going to them to offload their options on a monthly basis. You know, it could be Goldman Sachs, Morgan Stanley, whoever. And the reason for that is because they know that if they can't sell them to the retail investors before those expire, they can sell them to Universa. Thus, we have what's called the transactional edge. So every month, you know, certain options are expiring and there's new options purchased in that ladder from 1 to 9 months. And that's just a bulk of the positions. There's other things they're doing inside that. So I do know that, you know, on our account, it has about 8,000 trades per year. Those trades I don't have access to. Neither does the owner of Lionscrest, Claude Bouvet. So anyway, it's, you know, they don't disclose any of that. It's all proprietary. What's important for you to understand is that while Dave and his team are managing that 97 or 98% of the assets in the safe harbor fund, constructing that, making their clients wealth long term, we're protecting that. And so it's like your premium for your car insurance or for your home or life insurance. You pay a premium for that policy, for that protection. God forbid you need it. But, you know, the odds, and I said this in my interview, the odds of your house catching on fire in the United States is 25 basis points, or 1/4 of 1% on an annual basis. What are the odds of the S&P 500 having a market crash? Well, I showed that on the last slide I talked about. It's 2%. It's 8 times more likely to happen to have a market crash than for your house to catch on fire. But you have homeowners insurance, absolutely. You have car insurance, absolutely. You have disability insurance, more likely. Life insurance, more likely. So you have all these insurances, but no one's protecting their equities. And that's what Dave's doing for Canadians.
Yeah, and these portfolios have turned into people's largest single asset nowadays. The way the market's been so strong for many successful investors. And so Alex just went over, you cover your home carefully, but why would you do the same thing for your investment portfolio? Now, you could do bonds. You could be Warren Buffett. You could go to cash. And if you're managing your own money, that's an easy thing to do. But bonds, we still don't believe in. Maybe short-term bonds, maybe 2 years or less, because we still think there's a lot of duration risk there. We'd rather our alternatives be a replacement for bonds, and they've proven to be. We've got an excellent 16-year track record of almost 10% net of all costs, and a volatility of about 6%. So our alternative platform acts just like the old bond market did back when rates were on the secular decline. So did that answer your question?
I do race the option. What if they go bust?
Yeah, so there's no counterparty. There's no counterparty risk. So if it's like a Lehman Brothers or a Bear Stearns type of event where they're selling them, Universal only has to. Universal won't buy them direct from the market makers. They have to go through an exchange. So there's no counterparty risk. So the exchange is the one that is the mediator between the two. So they won't be holding it back. Now, if the exchanges go under, then we're in World War III. I guess I should say that because it sounds like we're getting close at times, but but thank you for that. It's a great question.
World War III, the market will love that.
So there's no over-the-counter options and no leverage.
Correct.
Okay.
Anybody else?
Yes, in the back corner, Joe.
Just on those $2,000 checks that Trump was going to hand out, it sounds like the courts cut the brakes on those. What would have happened if those went out? And really importantly, how could I get one?
Are you America?
No.
I guess you're out of luck. So you're talking about what the dividends he was going to pay Americans from the tariffs?
Yeah.
Well, you didn't see that the Supreme Court ruled against his tariffs, right? And the tariff, so that was something that they float. That was a trial balloon.
Well, I thought he exceeded his authority as president. I thought that's why they
It
started.
was always a trial balloon. I mean, they have the income tax refunds, which are up like 30% because of the one big beautiful bill that's giving people about $2, and that's going into the gas tank. But no, that was something that the Treasury sort of floated. it's something he would have liked to have done, but they waited until the Supreme Court decision, and now the International Court just ruled against whatever the Section 122 that he's pursued, that 50% broad-based tax. There's a lot that he thought there was a lot. He thought he could bypass the courts, and because he's done it most of his life, this time not so much.
Okay, well, that's great. Thanks everybody for your attention and consideration. We're going to move just down the hallway, I think it is, for a reception, and hopefully you stay around and ask any more questions, and be nice to meet some of you. That's Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit MacNicolasset.com to learn more.